Welcome back. If you're wondering where Objective 2 video is, we skipped Objective 2, so we're jumping right into Objective 3. So here under Objective 3, we're going to learn about the allowance method for estimating our bad debts. And so this contra asset account here is going to offset accounts receivable in the balance sheet and give us what we call the net realizable value. In other words, this is how much we actually expect to collect in cash, or how much we actually expect to realize in cash. So we're going to walk through just an example of how to do the journal entries first, and then we're going to come back and learn how to do the calculation for the bad debt. So here we're told that Smart Touch Learning has estimated bad debts are $80. Again, we're going to come back later and learn how to calculate that 80, but let's just learn all the journal entries first. So accounts receivable has a balance of 4,400. We know that balance is on the debit side of the T account because accounts receivable is an asset and all assets have a normal debit balance. So on December 31st, when we're doing those adjusting entries and we're recording depreciation and the supplies that we've used and the prepaid insurance and all that kind of good stuff, we're now going to do another adjusting entry to record our estimate of bad debt. So we're going to debit an account called bad debt expense and credit allowance for bad debt. So bad debt expense is obviously an expense account. We always debit expenses. Remember, allowance for bad debt is that contra asset account. Since contra means opposite, this has a normal balance that is the opposite of an asset. In other words, it has a normal credit balance. So we're going to make this exact same entry every year. The amount will change, but the entry itself doesn't change. Okay. Now, I want to point out that different textbooks, different professors will call these accounts different things. You may hear it called uncollectible account expense, an allowance for uncollectible accounts, or doubtful account expense, an allowance for doubtful accounts. Any of those is perfectly acceptable. You get the idea. It's a debt that we don't think we're going to collect. So here when I look at my T accounts, I show accounts receivable is 4,400. The allowance, the contra asset has a credit balance of 80, and then my bad debt expense is 80 also. So when I look at my balance sheet, I'm going to show accounts receivable at its balance of 4,400, and then I've subtracted out the contra asset. So I'm showing my stockholders, look, I'm owed $4,400. I'm hoping to collect $4,400. I'm trying to collect $4,400. But my realistic conservative estimate is that there's probably $80 of this I'm not going to get. I don't know which customers yet aren't going to pay me. It's just a guess. It's just an estimate that out of the 4,400, I'm not going to get 80 of it. So what I think I'm actually going to collect, what I'm actually going to realize in cash is 4320. I hope I'm wrong. I hope I get more than 4320, but this is my most conservative guess. Now, eventually, we're going to determine which customers are not going to pay us. And at that point, we'll write off their account. Now, how we determine that is different. It may be that we receive notice from the courts that they filed bankruptcy, in which case we legally have to write off their account. It may be we've received notice that they're dead. And so, well, you're not going to get any money from them now, so I need to go ahead and write off their account. It may be that I've just decided, you know what, I'm kind of through messing with this customer, and so I write off their account, or I take them to small claims court, and I just don't collect everything that they owe me, or they've just disappeared, or whatever. But eventually I decide I need to write off their account. Now, when you write off the account, we need to credit accounts receivable to take the account off of our books. But I'm also going to debit the allowance account. Remember, the allowance is the estimate of what I'm not going to collect. So if I'm writing this customer off, they're no longer an estimate. I know I'm not going to collect their money. So here we're told that customer Sean Clark, for whatever reason, we've decided to write off his account of $25. So I'm going to credit his account receivable and I'm going to debit allowance for bad debts. Now remember, allowance for bad debts is a contra asset. It has a normal credit balance. By debiting it, I am reducing it. So when we look at our allowance for bad debt T account, here I thought I was not going to collect $80. I have already identified 25. So what I'm saying is, look, I think there's $55 out there that I'm still not going to get. Maybe I do, maybe I don't know. If I guess exactly correct, then at the end of the year, allowance for bad debt will have a zero balance. Okay, let me say that again so you can jot it down. If I guess exactly correct, at the end of the year, allowance for bad debt will have a zero balance. If I have underestimated my bad debt expense, meaning if I have underestimated my bad debts, which means I have to write off more than $80 worth, then let's look at how this would work here. Let's say that I decide I have to write off another account, and this account is for $75. Now the balance in allowance for bad debt is going to be a $20 balance on the debit side. Remember, allowance for bad debt is a contra asset with a normal credit balance. So if I have underestimated bad debts, then at the end of the year, my allowance for bad debt account will have a debit balance, an abnormal balance. And we'll figure out what we do with that in a minute. If I end up overestimating my allowance for bad debt, so let's say I do have to write off one more account, but it's only for $10. Now allowance for bad debt still has a credit balance of 45. So a credit balance at the end of the year means I overestimated my bad debts. A debit balance means I underestimated my bad debts. Now, one thing I want to point out, let's look at the net realizable value before and after the write-off. So before we wrote off customer Clark's account, we said our net realizable value was 4320. After we wrote off customer Clark's account, notice that the net realizable value is still 4320. So writing off his account didn't change our net realizable value. It just says, hey, I now know that I'm not going to get his money, but I still am expecting to collect 4320. Now, occasionally, not very often, but occasionally it happens that we wrote off a customer's account and then they came back to us later and said, you know what, I was going through a really rough time period, but I'm back on my feet now, things are better, and I want to pay you the amount of money that I owe you. Okay. Now, again, this doesn't happen very often, but when it does, we're certainly not going to turn it down. So here it is on March 4th, customer Clark came back to us and said, I'm back on my feet now, and I would like to pay you the $25 that I owe you. So the first thing I need to do is undo the write-off. So since I originally debited the allowance and credited accounts receivable, I'm going to flip-flop that to undo the write-off. And then I'm going to do a second entry to show that I received his payment. So I will do like I always do when I receive a customer's payment, debit cash, credit accounts receivable. So this way his account is zeroed out, and now allowance for bad debts is back up to its $80 balance because I'm like, you know what? I misjudged him. Apparently I was a little too hasty in writing off his account. So now I still think I'm not going to get $80. Now, let's talk about how we estimate these bad debt numbers, that $80 that we were given. There's a couple of different methods that we can use. We're going to cover three of them, what's called the percent of sales method or the income statement method. And then we're going to look at two different balance sheet methods that are closely related but not exactly the same, percent of receivables and aging. So the percent of sales method is the one we're going to look at first. To calculate this one, we're going to take some percentage of credit sales. Now, it could be credit sales, it could be all sales. It just depends on our company. So management gives us some number. We've looked at past history and we've said, all right, we estimate that, again, I'm making numbers up here, 4% of credit sales are not collected. So all we have to do then is multiply our percentage by our net credit sales. So in our example, we're told that we think 0.5%. So 1/2 of 1% would be uncollectible. And credit sales were 60,000. So 60,000 times 0.005. Remember, to convert a percent to a decimal, you move the decimal 2 places to the left. So 0.5% is 0.005, which means we're estimating that out of the $60,000 of credit sales, we're not going to get $300. So we're going to now do the journal entry that we just learned to debit bad debt expense and credit allowance for bad debt for $300. Now, before I click off this slide, one thing I want to really emphasize here, and you want to highlight, star, underline in your notes, is that this formula is calculating the bad debt expense. Okay, this is going to become important in a minute. So the bad debt expense, the actual expense amount, the amount that you are debiting bad debt expense for, is the net credit sales multiplied by whatever percentage you're given. So now when I do my adjusting entry, I'm going to debit bad debt expense and credit allowance for bad debt. Now, I do like the note down here at the bottom. Says, notice that the only time you use the bad debt expense account is when you're doing this adjusting entry here on December 31st at the end of the year. We're never going to use bad debt expense any other time other than this adjusting entry right here. So now if I look at my T accounts, I see that accounts receivable has a balance of 6375. That was my beginning balance plus the 60,000 of credit sales. I wrote off customer Sean Clark's account. I collected $58,000. So accounts receivable has a balance of $63.75. Bad debt expense has a balance of $300. I do want to point out bad debt expense is an operating expense, so it will show up in our operating expense category of our multi-step income statement that we learned in Chapter 5. Specifically, bad debt expense is a selling expense. It's considered a cost of doing business. If you allow customers to buy on account, you accept the risk that they're not all going to pay. An allowance for bad debt, so notice it was $80 last year. We wrote off customer Clark's account. Turns out that we had overestimated bad debts, so we had a $55 credit balance coming into this year, and I've now added $300 to that. So my new balance and allowance for bad debt is $355. So on my balance sheet, I'm going to show accounts receivable of $63.75. And then right underneath it, I'm going to show allowance for bad debt of $355, which is going to give me a net realizable value of $6,020, if I did my math correctly there. Now, the two balance sheet methods, the percent of receivables and the aging method, are very, very similar. They have a two-step process for them. And I want to point this out because it's important that you recognize the difference. So step one is to determine the target balance in allowance for bad debt. In other words, you are determining what does the ending balance in allowance for bad debt need to be. And then step two is to determine what amount of bad debt expense needs to be recorded in order to make allowance for bad debt equal that amount. So you are not determining just in one step what bad debt expense is. So let's walk through an example, and I think that will make it easier to understand. So we know that allowance for bad debt coming into this year has a credit balance of $55. We also know, if we remember, that accounts receivable has a balance of $6,375. We're told that we estimate, based on past history and current state of the economy and things like that, that bad debts would be 4% of 6375. So if I multiply 6375 by 0.04, I get, when I do my math, $255. So 6375 multiplied by 0.04 is $255. So what this $255 is really what my target balance, my target ending balance in allowance for bad debt is. So that should always be on the credit side because allowance for bad debt is a contra asset with a normal credit balance. So I want to draw my T account and make allowance for bad debt be $255. So then the step 2 is I need to determine how much do I need to adjust allowance for bad debt by to make it go from 55 credit to 255 credit. And so in order to make this balance go from 55 to 255, I need to have a credit of $200. So my adjusting entry would be to debit bad debt expense, credit allowance for bad debt for $200. This adjustment right here is my bad debt expense amount. So there we've got our target balance and we've drawn out our adjustment here. So the key thing to remember is that you are not calculating the bad debt expense, you're calculating the ending balance in allowance for bad debt. So now I'm going to do my journal entry to debit bad debt expense and credit allowance for bad debt for $200. And so after I post all those entries, notice accounts receivable is 6375, bad debt expense is now 200, and the allowance for bad debt is the 255 that I said it should be. Now, let's look at a slightly different example. So here we're told we have Martin Music, and Martin Music has a debit balance in his allowance for bad debt account. So remember, we said a couple of slides ago that that debit balance happens when Martin underestimates his bad debts. So Martin's bad debts this past year were $150 more than he had thought they were going to be. So he wound up with a debit balance and allowance for bad debt. So now we're told that Martin estimates that bad debts this year are going to be 2% of his $40,000 of accounts receivable. So if I did my math correctly, 40,000 times 2% is $800. So Martin needs his allowance for bad debt account to have an ending credit balance of 800. So the question then becomes, how much does Martin need to adjust his account by to make it go from 150 debit to 800 credit? So hopefully you said he needs to credit allowance for bad debt by $950. He has to credit it for more than in order to make up for last year's underestimate. If you said 750, if you just did the math and subtracted, sorry, and said, what was it, 550, 650, I don't do math in my head very well, then that would not be correct, and I encourage you to draw that out and try it here. So Martin has to credit his adjustment for $950 in order to make up for the $150 that he underestimated last year. So he'll do his journal entry to debit bad debt expense, credit the allowance for $950. Now, the aging method is similar to the percent of receivables method in that you are calculating the target balance in allowance for bad debt. The difference is that we're not just multiplying a percentage by total accounts receivable. We're going to break accounts receivables into groups based on how old they are, with the idea that the longer an account is outstanding, the less likely we are to collect it. Let's look at an example. So here we've listed all of our accounts out, whether they are 1 to 30 days, meaning they're current. And so we think, hey, we're going to get 1% of those. If they're a little bit late, 31 to 60 days, we think, well, we're going to collect 98% of that. There's only 2% we're not going to get. Now you get over 60 days, well, we think, okay, look, there's 3% of this I'm probably not going to get. But notice, once an account is over 90 days, I think that there's a 90% chance I'm not going to collect this. So you multiply your percent by your total for each category, and then you add them up. And so this total over here, this 185, this becomes my target balance in allowance for bad debt. So again, I'm going to determine the target balance by using the age of each account and multiplying the age by the percent and then adding all that up. And then I'll back into the bad debt expense amount. So in this case, since I know the target balance needs to be 185, it was 55 before, 55 credit, we're back to being Smart Touch Learning, and I'd need it to be 185. That means I need to have an adjustment of 130. So my adjusting entry needs to be to debit bad debt expense, credit the allowance for bad debt for $130. And so now, again, when I look at my T accounts, accounts receivable still 63.75. Allowance for bad debt is the 185 that I said it should be. And on the income statement, bad debt expense will show up as an operating expense for 130. Now, this is just a comparison of the different approaches. Remember, the percent of sales method is calculating the bad debt expense directly. The balance sheet approaches calculate that ending balance in accounts receivable. So it's very easy for students to get that confused. And so I want you to have good notes written down, and then you'll practice this a lot in your homework also.